Welcome. My name is Michael Morando. I'm with Tremblay Financial Services. Today we're going to be discussing long-term care. You can call this lunches with Mike, brown bags with Mike, education with Mike. We're just trying to get a series of informational sessions out there for people. We're trying to build content so that people can get access to it. This is a live webinar, and we will be making it available for replay. So our topic of conversation today is long-term care. And as we've experienced the stories behind long-term care over the last 10 or 15 years, the world as we know it has changed. And so we, the baby boomers, and I'm pointing at myself, have demanded of the insurance companies a product that fits our lifestyles. And so what we've seen is long-term care has evolved over the past 10 or 15 years as the insurance companies have tried to determine how are they going to provide this product for us? How are they going to hedge? How are we as consumers going to hedge against our medical liability for the purpose of long-term care? And over the last 15 to 20 years, the insurance companies have slowly but surely gotten experience in this whole area. And so the products have started to evolve to meet our needs. And so with that being said, I'm going to bring on our co-presenter here this afternoon, Ian McDowell with True Choice Financial. Ian has been in the insurance and long-term care industry for going on 20 years. So he's been through this whole evolution. And today he's going to share a number of thoughts with us, kind of take us through what those changes might look like, what some of the options that are available to you. We're going to keep it pretty high level just for educational and thought process, but we're going to touch on a few different products and give you a few ideas. As we go through this, there's a chat box over on the right-hand side. Please feel comfortable to pop me some questions, and as we go through, I will, towards the end, or when it's appropriate, I will pose them to Ian. And we've got some time to be able to address some of those questions. So with that being said, welcome, Ian.
Well, thank you, Mike. I appreciate it. So thank you, everybody, for having taken time on the call for me today. We're going to cover basically planning for long-term care, and that's going to be the educational side of it. So like Mike said, very high level. A lot of the information in the presentation Mike has in basically a 3-page overview of a highlight of everything we're going to cover. So it's more to listen and take notes or questions that you have. But I am going to start with 3 original questions, which is, do I have a plan? Am I protected? And if you said yes to both of those, is the plan I have in place the right one for me? So those are the 3 questions I just want you to think about as we go through the presentation on planning for long-term care. So what we're going to cover today is, what is considered long-term care? Why should I consider potential long-term care needs as part of my retirement strategy? When is that needed? What questions should I ask myself when creating a plan for long-term care? What options are available for long-term care need? And then what are my next steps going forward? So what is considered long-term care? It's kind of in 2 buckets. You have the informal method and the formal method. I would say probably majority of Americans probably fall into the informal method side. Obviously, informal method is going to be relying on your family, your friends, your community. It would be the least expensive bucket out there for your long-term care needs. But that the least expensive bucket also causes more drama, trauma, concern, because you're putting more on other people. So usually when I do this in front of a seminar in front of live people, I ask how many people have dealt with long-term care within their families, friends, community, and probably 9 out of 10 people hands have gone up in the room. And how did that experience go for you? It's very rare you get a positive feedback, especially on the informal side, because it's either your spouse taking care of you, a child has to relocate to take care of, that individual, and vice versa. And we're going to dig in a little bit further into the informal side. The formal method is obviously there's an additional cost for that, but in turn, during those retirement years when you need long-term care, you're getting an extra level of care. And what falls under the formal method is going to be your assisted living facilities, nursing homes, qualified in-home care. Nursing home probably being the top of the top, a private room at a nursing home. But there is a cost associated with that. But the ease and the transition during that time of your retirement is a much better living scenario. So how you qualify for long-term care, especially for the formal methods, is 2 of the 6 activities of daily living. So this is pretty common across all coverage or across the board as far as long-term care facilities, carriers or plans, long-term care plans, paying that benefit is 2 of the 6. So for example, I get up in the morning and I get out of bed. That's my transfer. I go into the bathroom, I take a shower, use the bathroom, I come back out, I get dressed for the day, and, I grab a banana on the way out the door. So I've done all my activities of daily living probably within 30 minutes to an hour. So if any of those 2, you can't qualify, so you can't dress yourself, you need help eating or bathing, that's what would qualify or trigger for a long-term care event. So why should I consider long-term care when planning for retirement? This is a pretty telling statistic. So basically the statistic right now is 70% of individuals 65 or older will need some form of long-term care. So 70% of 65 or older will need some form of long-term care. The 4.2 years is the average stay in a long-term care facility or needing long-term care. If that's somebody coming to the house, going to a facility, if you need long-term care, about 4.2 years, you'll be requiring help. Now, the 4 to 8 years is if you had a cognitive. So your mind might be breaking down with dementia or Alzheimer's, but your body might not be breaking down as fast as your mind. So that average goes from 4 to 8 years based off that. All right, when is long-term care needed? We already covered that 2 of the 6 activities of daily living, but other health issues can fall into that category. So falls or other accidents. So obviously, an individual falls, they break their hip, they're not going to be able to do the transferring out of the bed or the dressing of themselves or the bathing. That qualifies. Chronic illnesses, strokes, and then we covered the cognitive impairments like dementia or Alzheimer's.
Ian, we have a question that asked, is there an age limit on the use of the long-term care? I mean, can you do it in your 30s? Can you do it in your 40s? If you have the product, is there a limitation on an age limit?
There is not a limitation on the age limit when you can utilize it. Now, obviously, if I had a client that was 90 years old and wanted to get long-term care coverage, that would be tricky. But yeah, if you needed long-term care for an accident or whatever reason, and you're 40 years old, 60 years old, 70 years old, there's no age discrimination when it comes to that.
Excellent. Thank you.
All right, what questions should I ask myself? So, and we're going to cover some of these, is how can a long-term care need affect my family and my retirement strategy? Where should I consider receiving the care? That's going to go into the informal or the formal. We're going to cover what potentially it could cost, and then what are my options in covering that cost. So how can it affect my family and or my retirement strategy? Again, we covered a little bit of this already, but the informal care, things to think about is, who will be providing that care. Some people just want to go the informal route, but they need to think about, is it going to be my spouse? Is it going to be my kids? Do my kids live in another state? Are they going to have to relocate, quit their jobs? Those are the kind of things you have to, a client has to think about when it comes to if they're wanting to utilize informal care. And then if formal, what are you comfortable with? Is it, somebody coming to your house on a daily basis or a couple times a week, to help you out? Is it a full-on private room nursing home? Is it an assisted living? Some things to kind of do research on within the area. Insurance or portfolio asset, and if an asset, we're going to kind of cover that in a later slide, so we'll just pass on through there. All right, what could it potentially cost? So costs can vary on a number of ifs. So again, who is giving the care? Where is care being given? How long can care be given? And what age is the care needed? And then know the cost in your area. So I'm going to pull up an app for your specific location so I can go over the costs right now associated. So Mike, what would be would it be the LA or closer to like Oxnard, Ventura?
You know what? Let's just do Santa Barbara for the shock and awe.
All right, so the closest one I have they don't have Santa Barbara right on there, but they have Santa Maria or Oxnard.
Let's go with Santa Maria.
Okay. All right, so Santa Maria, to give you an idea, currently, so home care, which is essentially somebody coming over to your house in your own comfort, is about $5,800 a month right now for that one. So that would be $70,000 a year. If you wanted a private one-bedroom assisted living facility, that's about $5,200 a year. And then the nursing home, which would be like the cream of the crop, is about $10,600 a month for a semi-private room. And if you wanted your own private room, it would be $12,000 a month. So either $127,000 a year for semi-private or $146,000 a year. Now let's just take that one step further and just look at inflation and costs of time. And let's look at 10 years from now. That semi-private room went from, I believe I said 120 something to $171,000 a year. So it jumped about $50,000. And the private room went to $196 a year. So I bring that in. I know those are scary numbers, obviously. That's why we do these educational, is because, we want to put clients into situations where they're not having to pay potentially anywhere from $120,000 to $190,000 a year. But it gives you a good idea, and we have recommendations around, how to kind of simplify that. So that kind of gives you an idea, and you take that 4.2 year average, that can potentially cost, depending on what kind of care you want, $70,000 a year being on the low end right now to $140,000 being on the high end, depending on your care. You're looking at $500,000-$600,000 over a 4-year time frame for long-term care. All right, what are my options? I'm not a Medicare, Medicaid specialist, but what I do say to this one, every state is different. Some states require you to drain down all your assets before you even kick in. Usually what I kind of raise to the question to the room is, who do you want to have control over your living arrangements when it comes to your retirement, your long-term care? Do you want to have control of that, or do you want the government to kind of tell you where you where you're going to spend that time in long-term care. Is there enough beds? Do we have to move facilities? How long can you be in this facility? 10 out of 10 times, the people in the audience, would like control of their own retirement and long-term care solutions. We can go to the next slide. We'll cover self-funding right here. So we're going to kind of go over 4 different options to help you understand what are your options as far as paying for long-term care. So self-funding is basically you're using your own assets, and you have Bob here. He requires long-term care. He has 4 buckets of money that he can use for self-funding. Typically, these are going to be your savings, money markets, annuities, IRAs, stocks, bonds, mutual funds, and real estate. So if you got to that point where you needed long-term care, if it was for a facility or you wanted to, pay a relative to relocate and take care of you, you're going to have to drain down some of your own assets to pay for that long-term care need. So that would be option 1. This we've already covered. It's just kind of going more into the informal care. Again, just thinking about the availability of proximity, the financial, physical, emotional impact to that caregiver if you want to go informally. Or it's leveraging insurance, and that's going to be the 3 next scenarios we go into. So the next 3 options, so obviously we've already covered 1, which was just self-funding. The other 3 are different options to help leverage the dollars now, so you're not paying that $140,000 a year every year that you need long-term care. We're going to basically cover traditional long-term care insurance, life insurance with an optional LTC rider, and then linked benefit products, and I'll explain each one when we get to the slide. All right, so how traditional long-term care works. Again, when I'm speaking to clients about this, raise your hand if you have or know somebody that had traditional long-term care. Good number of hands go up. What has been their theories, a lack of a better word, but their experience with standalone long-term care? Usually everybody's nodding their head in a negative fashion, and they're right. Like Mike said at the intro of this, life insurance and long-term care has come a long way over the last 5, 10, 15 years, and it's more for a benefit for the client, and you'll see that in the next 2 scenarios. But the standalone long-term care, it wasn't priced right by a lot of the insurance carriers back in the day. Honestly, now there's very few carriers that do standalone long-term care. Most of them have gotten out of the business of standalone long-term care. Standalone long-term care acts kind of like term insurance, if you're familiar with that. You pay those premiums, for X amount of years, but if you never use the long-term care, there's no benefit to you or to a beneficiary at that point. So it's a use it or lose it. Now, the other problem with that is how they priced it. So a lot of people, my parents, for one, who got theirs 30 years ago, they're now getting annual reviews or policy statements saying, hey, if you want to keep this benefit, you're going to have to pay more premium. Or if you want to keep this benefit, or if you want to keep the premiums you're paying, you're going to have to reduce your benefit. So that's happening, and it's outpricing a lot of the clients now for these standalone long-term care. So I say that because it's changed. That's what it used to be. I don't want that to be a stigma now when it comes to long-term care, and I'm glad we do a lot of these educational when it comes to life and long-term care, because it has changed a lot, and honestly, a lot of carriers don't even offer standalone long-term care anymore. All right, so our third option with Bob here is one where we have life insurance with an optional long-term care rider. So majority of all the AA plus carriers offer these type of products, but you see Bob, and he has 2 buckets, and they're the same size. So you have the LTC benefit and the death benefit bucket. So let's just kind of walk through a scenario here. I buy permanent life insurance that has $500,000 of death benefit, and I attach a rider to that death benefit, a long-term care rider. So I have $500,000 of permanent life coverage with the long-term care rider. So let's walk through a couple scenarios. So if I pay the premiums for this coverage, if I never use it for long-term care and I pass away, somebody is getting that death benefit of $500,000 tax-free. Go back to the last slide for me, Mike. So if I never use the long-term care, my premiums went to that death benefit of $500,000 tax-free that my beneficiary, my kids, my grandkids, my church, whoever it may be, will get. Now, I also have $500,000 to pull down from for long-term care. So let's walk it through another scenario. I get into that $500,000. I need long-term care. I start pulling out money to pay for that. I've used $250,000 of that $500,000. I pass away. Somebody is getting $250,000 of death benefit, and I use $250,000 for my long-term care. And then I can bleed through pretty much 95% of that $500,000 for long-term care. So that's the third scenario with the two buckets, the long-term care only and the death benefit. So you'll see just in that third scenario that we're giving more to the client. Your premiums that you're paying, we're leveraging that up for death benefit and long-term care, and somebody is going to either utilize it for long-term care or get it from a death benefit perspective. Now, the last option, which we're on, is how linked benefit products work. So the third scenario, where it was the two buckets, is, I meet with a client and they have a need for both. They want to make sure their family is protected from life insurance, for income replacement, whatever the reason may be, but they also have the same need for long-term care. That's where that one comes into play. This last one's a little bit different. This is where if I had a client whose main concern was long-term care, didn't really care too much about the death benefit, but really wanted to leverage up their premiums for long-term care. So here you see Bob has three different buckets. Long-term care bucket being the biggest, death benefit, and return of premium. So again, more flexibility for the client. This client puts in X amount of premiums, and let me just pause on the premium standpoint. Mike represents 25 to 30 of the best carriers in the industry, all well known, that everybody would know of. These can be constructed to every client. Every client's need and wants are different. So from a premium standpoint, we have some clients that just want to pay one time and be done with it. We have clients that want to pay for 10 years, 15 years, 20 years, or the life of the policy. All these can be customized depending on what you're wanting to achieve. So in this scenario, let's just give an example. A client puts in $10,000 a year for 10 years. So they put in a total of $100,000. At the end of that 10 years, that first bucket, the return of premium, they have the option at that point and going forward to get all their money back. So if they're like, 10 years down the road or 15 years down the road, I don't care about long-term care anymore. I just want my $100,000 back. They'll write you a check for your $100,000. Now that $10,000 a year over 10 years might buy a death benefit of $140,000, but that wasn't the objective. The objective was for more long-term care. But their long-term care benefit might be that $100,000 might buy $400,000 for long-term care. So again, leveraging, not quite pennies on the dollar, but close to it, of $100,000, full walk away if I wanted it. But now I have $400,000 to use during for long-term care. And those are basically the four different styles, the self-funding, standalone long-term care, and then the two options. Now, what I do want to pause on, a lot of the carriers that Mike works with, how they pay out that long-term care, because I do think that's important. There are some companies that require you. So, say I qualify for 2 of the 6 activities of daily living. I still want to. I want to start using that bucket of money for long-term care that I want to pull from. Some carriers require you to do a receipt or a reimbursement. So, if I have somebody come to my house, I got to keep that receipt that I'm paying them, or I go to a nursing home, I get that receipt, I send it to the carrier, and then they send you your benefit. The other one is called indemnity, which is basically they pay it to you as cash. You do not need receipts or reimbursement. I kind of prefer that one because you have more control. So when you qualify for 2 of the 6 activities of daily living, all you do is go to the doctor. They write off that you qualified for 2 of the 6. You send it to the carrier, and then the carrier will start sending you a check, and you can designate it. But let's just say they're sending you a check for $10,000 a month. So, but it's paid as cash. So now you have the availability to do what you want. So if you wanted to your daughter wanted to take care of you, you now have the ability to pay for her to do that or to relocate. It just gives the client more flexibility. So there are some options with that. So, what are the next steps? Think about a written strategy. Think about the informal, the formal, cost, where you would want to live. There's a lot of information there. Discuss it over with Mike. Plan on how you should fund that strategy. And a lot of those solutions should include the benefit amount. What are you comfortable with? Are you comfortable with planning for 4 years potentially in long-term care? The length, the type of care received, inflation, we covered that, what the cost of it is now opposed to 10 years from now. And then obviously the financial impact on current retirement strategy. How would that affect your retirement, your retirement? But, just in wrapping this up, Mike's one of the best in the business. Been working with him a long time. He really takes in consideration the client's needs and the wants, and really figuring out the best package after listening to the client and seeing what they need. So other than that, I appreciate everybody taking the time out of the day and listening to a little bit of education on life and long-term care, and hopefully everybody learned a little something.
Ian, thank you very, very much. We appreciate your time. Yes, I think what we can walk away from this with is that we want to be deliberate about our decision making. One of those sayings we have is, by not making a decision, we're making a decision. So what we want to do is look at long-term care. We want to evaluate it. We want to give it its due consideration. We want to be deliberate about our information gathering. And then we want to be an execution of a decision, because we'd hate to look back 10 years from now, 15 years from now, 20 years from now and say, you know what, I kept putting it off. It's something that I've been thinking about, but here I find myself today, 10, 15, 20 years later, and now I am self-insuring. Now, that's not a bad option to do, but let's make the decision now that we're going to self-insure later. Again, by not making a decision, we're basically making a decision to self-insure. There's a lot of great tools out there for us. There's a lot of great products, as Ian alluded to. The insurance companies have tailored solutions for all of us, and each company brings its own little twist to the game. And so we'll go out and we'll shop specifically for your need, and we'll find something. And again, we'll put the presentation together, give you an idea of what we can do based on our discovery meeting. And then from there, you can make a decision. Now, it may make sense to make that decision now. It may make sense to push off for later. But again, let's be deliberate in that decision making. So with that being said, up in the upper right-hand corner here, I've put a ability for you to make an appointment. If there's some times here in the next week or two that you've got available to you, please, that'll take you to my Calendly site, and you can set up an appointment with me. Once again, Ian, thank you very much for your time and your help in this matter.
Absolutely.
It's our pleasure to share this information with you. Keep your eyes and ears open for additional information. We'll get into some different topics like life insurance itself. Today we kind of did life insurance with a long-term care view, but we'll do life insurance, we'll do Social Security, we will do managed money, we'll talk about stocks, bonds, and mutual funds, we'll talk about annuities, We'll talk about a number of different topics that are timely. Our next presentation coming towards you is going to how to retire in a COVID environment. Right after that is going to be a series on who will inherit the mess. And that basically is focused on how we're going to address our estate plans. That's our wills, our trusts, our medical power of attorney, our durable power of attorney, our 5 wishes, and all of those documents that we need to address when we are kind of at our end of long-term care scenario. So with that being said, blessings upon you and yours in this environment, and we look forward to speaking to you all in the future.